The charts in the opening weeks of 2026 do not resemble a standard financial trend line so much as they look like the vital signs of a market undergoing a violent structural metamorphosis. We are witnessing a seismic shift that has left Wall Street veterans and retail investors alike staring at their screens in disbelief, as silver, often derided as the volatile, poorer cousin of gold, has staged a rebellion that defies traditional logic. In a matter of weeks, the metal has surged approximately 25%, shattering psychological ceilings and briefly piercing the stratosphere above $93 per ounce. While the price has since settled into a volatile dance around the $90 mark, the message is unambiguous. The old rules of engagement for precious metals have been suspended. This is not merely a price spike, it is a declaration of a new era where industrial necessity collides with monetary fear, creating a perfect storm that few saw coming with such ferocity. To understand whether this is a fleeting bubble or the dawn of a new asset class dominance, we must peel back the layers of hype and look at the raw, pulsating machinery driving this ascent, a machinery greased by panic, geopolitics, and a level of demand that the Earth's crust is struggling to satisfy. To truly grasp the magnitude of what is happening in early 2026, one must first step away from the glowing tickers of the present and walk through the ghosts of silver's volatile past. History is littered with the wreckage of those who underestimated this metal's capacity for explosive, irrational movement. The spectre of the Hunt brothers in 1980 looms large over every silver rally. In that infamous episode, two Texas oil tycoons attempted to corner the market, driving prices from $6 to nearly $50 in a frenzy of accumulation that threatened to bankrupt brokerages and destabilize the financial system. That rally was artificial, driven by manipulation and greed, and it ended in a spectacular collapse that scarred a generation of investors. Fast forward to 2011, and we saw another surge toward $50, driven by the debasement of the dollar and the aftermath of the great financial crisis. Yet what we are witnessing in 2026 feels fundamentally different. The ghosts of 1980 and 2011 were summoned largely by speculation and monetary policy. The monster of 2026 is being fed by a voracious physical hunger. We are no longer dealing with a market solely dictated by men in suits trading paper contracts. We are dealing with a world that physically cannot function without silver. This distinction is critical because it suggests that the floor beneath these prices is made of concrete utility rather than speculative air.
However, the narrative of industrial demand is only the surface-level explanation, the polite cover story that analysts recite on television. Beneath this lies a darker, more complex web of financial flows that suggests a quiet panic is setting in among the global elite. The numbers tell a story of frantic accumulation that goes far beyond the need for solar panels or electric vehicle components. We are seeing a massive influx of capital into silver-backed exchange-traded funds, ETFs, with nearly $922 million flooding into major trusts like the iShares Silver Trust in a startlingly short window. This is not just smart money hedging against inflation, this is a stampede. When nearly $1 billion moves into a specific physical asset in such a condensed time frame, it signals that the market participants are losing faith in the paper promises of fiat currency. They are demanding the metal itself. This rush has forced the custodians of these funds to scour the globe for physical bars, tightening a supply chain that was already stretched to its breaking point. The sheer velocity of this capital injection indicates that investors are no longer treating silver as a speculative side bet, but as a primary defensive asset, perhaps even more urgent than gold, given its dual role as money and industrial material.
The intrigue deepens when we scrutinize the shadowy world of paper silver, the futures and derivatives market, where the price of silver is ostensibly discovered. For decades, conspiracy theorists and astute analysts alike have argued that the price of silver has been suppressed by massive short positions held by bullion banks, creating a disconnect between the paper price and the physical reality. In early 2026, that disconnect appears to be snapping. The volatility we are seeing, including sudden intraday drops of 9 to 11%, followed by rapid recoveries, bears the hallmarks of a violent struggle in the futures market. These flash crashes are often the result of margin calls and forced liquidations, a mechanism used to shake out the weak hands. Yet, unlike in previous years, the price is bouncing back with resilience. This suggests that the short squeeze, a scenario where those betting against silver are forced to buy it back at higher prices to cover their losses, is no longer a theoretical possibility but an unfolding reality. The paper market is losing its grip on the physical market, and the resulting friction is generating the sparks we see on the price charts. Adding fuel to this fire is a geopolitical maneuver that has largely flown under the radar of the mainstream press but is central to the current crisis, the tightening of export controls by China. As the world's refined silver powerhouse, China's decision to restrict the flow of silver to the global market is akin to turning off a tap in the middle of a drought. This is not an accident, it is a calculated strategic move. By hoarding silver, China is securing the essential raw materials for its own dominance in the green energy and high-tech sectors, while simultaneously starving the West. This supply shock creates a multiplier effect on the price. When you combine a restricted supply from the East with a voracious demand from Western investors and industries, you create a mathematical inevitability of higher prices. The market is waking up to the fact that the available silver in London and New York vaults is a fraction of what is claimed on paper, and the race to secure physical possession is driving premiums to levels that make the spot price look almost irrelevant. Furthermore, we must consider the psychological dimension of this rally, championed by vocal figures like Robert Kiyosaki, whose prediction of silver hitting $107 by mid-January 2026 has added a layer of self-fulfilling prophecy to the frenzy. While skeptics may dismiss such precise targets as sensationalism, the influence of such narratives cannot be ignored. In an era of algorithmic trading and social media-driven investing, sentiment is a fundamental force. The fear of missing out, or FOMO, has gripped the retail sector, which sees silver as the last undervalued asset on Earth. This psychological momentum is crashing into the hard walls of supply constraints. Unlike gold, which is hoarded in vaults, silver is consumed. It disappears into landfills, into electronics, into chemical processes. The above-ground stockpiles of silver are historically low compared to the monetary base. We are analyzing a market where the burning rate of the commodity exceeds the replenishment rate, and now, finally, the price is beginning to reflect that existential scarcity. As we stand in the early days of 2026, looking at a 25% surge, we are not just looking at a profitable trade, we are staring at a fracture in the financial system. The rise of silver is a symptom of a broader loss of confidence in the stability of currencies and the transparency of markets. The hidden financial figures, the leverage in the futures market, the dwindling registered inventories on the COMEX, the massive ETF inflows all point to a market that is being cornered not by a pair of brothers in Texas, but by the relentless reality of supply and demand in a fracturing world. The volatility is not a bug, it is a feature of a market trying to find the true price of a finite resource in an infinite sea of liquidity. The question is no longer whether silver is valuable, but how much the paper currency used to measure it is truly worth. The geopolitical chessboard reveals the true nature of this squeeze, extending far beyond simple market mechanics into the realm of national security and industrial survival. While Western media remains fixated on daily price fluctuations, the BRICS nations have been quietly executing a strategy of accumulation, treating silver not merely as an industrial input, but as a strategic monetary asset essential for bypassing the dollar standard. This state-level hoarding runs parallel to the insatiable appetite of the green energy sector, where solar panel manufacturers and electric vehicle giants are now bypassing the exchanges entirely. These corporations are engaging in direct off-market agreements with miners to secure supply lines that the open market can no longer guarantee, acting as silent whales swallowing the plankton of available inventory, effectively removing huge swathes of metal from the public ledger before it ever hits the vaults of London or New York. In this high-stakes redistribution of wealth, the divide between the victors and the vanquished is becoming brutally clear. The losers are the institutions tethered to the paper derivative market, those entities that sold promises of silver they never possessed, banking on the eternal suppression of price to cover their naked short positions. They are now facing a solvency crisis as margin calls turn into existential threats, forcing them to cannibalize other assets just to keep their positions open. Conversely, the victors are not the high-frequency traders chasing quick flips, but the patient holders of physical assets who understood that in a debt-saturated world, counterparty risk is the ultimate enemy. This transfer of wealth is flowing from the computerized ledgers of Wall Street to the private vaults of those who recognize that tangible scarcity cannot be printed into existence by a central bank decree. The endgame of this global maneuver is not merely a temporary price spike, but a fundamental revaluation of what constitutes valid collateral. We are witnessing the chaotic transition from a system based on faith in government debt to one anchored in tangible reality. The surge we are seeing in early 2026 is the market's violent attempt to find equilibrium after decades of manipulation, signaling that the era of cheap resources is over. For the investor standing on the sidelines, the window is closing, not because the price is becoming too high, but because the physical availability of the asset itself is vanishing. The story of silver in this decade will ultimately not be written about its price in dollars, but about the sheer volume of depreciating currency required to convince a holder to part with their metal, a distinction that marks the death of one financial epoch and the turbulent birth of another.